Well, last week I said markets had everything they wanted, and this week the optimism continued. Hi there everyone, welcome to the Traders Circle weekly market update. Today is Tuesday, the 14th of November 2023, and just before I get into it, you do need to be aware that whatever I say is general advice only. So it doesn't consider your personal financial circumstances, and you have to decide whether it's appropriate for you. Alright, so markets have pushed quite strongly higher across the past fortnight, and that does come after the US Federal Reserve meeting for November, right at the start of the month. Now the Fed basically, well, they didn't exactly say so, but all the investors interpreted the meeting and its accompanying statements to mean that interest rates are at their peak, they're not going to go any higher, and that the next move will be a rate cut. Now, if you look at the FedWatch tools and the expected future rate movements, the market's pretty much expecting that rates will be cut around the middle of next year. The one thing, at least in the short term, that could sort of disrupt this is tonight's US CPI reading. So CPI is an analog for inflation. It's a measure of how rapidly prices are growing year on year. And if this CPI reading comes in stronger than expected, we might start to see more rate rises be priced in, or we might see that rate cut be pushed further out in time. So it is a very, very important reading. It is expected to come down further. I think it's expected to come in around 3.3%, down from 3.7%. It is still a bit above target range, but the fact that it is coming down fairly strongly, fairly rapidly, is a good sign, or hopefully it will be a good sign. And probably means that they can hold rates at the current level. Anything above that, though, we do risk some selling in markets. And I do just want to say that do be careful as well around this reading. For much of the past year, the response to these CPI readings has actually come a day after the reading. I want to make that clear again. If you see the number and you're a bit surprised by the market's response initially, wait till the next day, and that's often where you get the actual market response to the reading. So very important CPI reading tonight. Could go either way. Obviously, it's expected to come right down. CPI in the Eurozone has come right down. They're at 2.8% year-on-year growth. That's actually inside target ranges now, and it is a sign that the higher interest rates are working to bring down prices. Very, very important reading, and at least in the short term, is going to be what decides whether markets continue to push up or whether they do see a bit of a pullback. So the one thing that's worth sort of keeping an eye on at the moment with regards to this sort of peak rate hope is the bond yields. Bond yields did sort of peak out right around that Fed meeting, and they've been coming down since then. They've been falling for the past fortnight or so. That's the same in the US as it is here, and that's despite the RBA rate rise last Tuesday. Despite all of this, we are seeing those bond yields continue to come down, and that's the sort of key barometer as to whether the stock market's going to keep rising, whether they're going to keep pricing in this peak rate view, or whether things start turning around. If you do see those bond yields start turning around, if they do start heading back up, that's probably a sign that there's a greater likelihood of more rate rises, or at least those 2024 rate cuts are being pushed out in the minds of investors. So the bond market often a lot more sensitive to these things, a lot more obvious in their movements, a lot more deliberate, and generally the direction of yields is a bit easier to follow with regards to how people are pricing in rate movements. Finally, the other thing that's important for the Australian market at the moment, that's important for our rate outlook, is the unemployment reading. That's going to come on Thursday about 11:30 a.m. I believe, Australian Eastern Daylight Savings Time, and that is expected to be a slight uptick in unemployment. Believe it or not, and I know it sounds terrible, but that's actually what our market wants to see at the moment. They want to see a rise in unemployment, because that's a sign that these higher interest rates are working to cool the economy. And unfortunately, that's the only mechanism by which the RBA has to bring inflation down, or the only one that really works. So they do want to see, unfortunately, a slight uptick in unemployment. That's a sign that things are starting to cool, and a cooling economy is what eventually brings inflation down. Our inflation is still much higher than that in the US, much higher than Europe, obviously, and still, well above our target ranges. So, unless we do see it start coming down, if our inflation holds around here, we will see more rate rises. It's only the expectation that it will come down from here that is causing investors to price in our own interest rate peak. And so I did want to touch on that. We did see a rate rise last week from the RBA, but despite that, our market is basically saying, well, we think that's the last one. We think that, now that they've done that rate rise, we're happy to follow the US belief. We're happy to go, oh, the US has peaked in their rates, so that probably means we've peaked as well. It's a little bit of a dangerous view because, if our inflation remains high, like I said, we will eventually see more RBA rate rises. The hope, though, is that if the US rates have peaked, and our outlook is a little bit more hawkish or a little bit more likely on further rate rises, then that could cause a bit of strengthening in the Australian dollar, and that could lead to slightly lower, say, energy costs, because fuel might be slightly cheaper in Australian dollar terms with a stronger Australian dollar. It could lead to lower import costs in general, and that could eventually bring our own inflation down. A little hard to say though. But I think our market at the moment just happy to basically say, well, the US might peak, their inflation's coming down, inflation in Europe's coming down, inflation in Asia is very, very low. Our inflation might come down as well. And a lot of inflation, well, that we know of is about expectations. And if people are expecting it to come down, suddenly you've got businesses less likely to raise less likely to raise prices, and inflation comes down as well. So let's have a look at the charts for this week. This is our own market, the XJO, the top 200 stocks, and it has been on a fairly strong downtrend since the peak of July. So we have set a trough and a peak recently, and these troughs and peaks are still lower than the previous troughs and peaks. That's still indicative of a downtrend. At the moment, we'd have to get back to about 7,100 to set at least an inline peak, which would be a sign that this downtrend is breaking. So despite all the optimism across the past fortnight, we still haven't quite broken higher. And I'm not sure we're going to do it on the current upwards move. I still think there's a very reasonable chance that we do come back down to, say, 6,900 and then set a higher trough. And the higher trough is a potential signal that we are setting a change in trend. So that's what I'd be looking for. I'd be looking for us to potentially pull back here and then basically set a higher trough than the previous trough, which for me would be a sign that we're seeing a bullish change in trend. Otherwise, if we do break through the downtrend line and come back to 7,100, that would also be a sign for me that we're breaking the downtrend. For US markets, they've already sort of broken their downtrend. They've already set a higher peak than the previous peak. They do look a bit overbought though. They have obviously jumped very, very strongly across the past fortnight. They've gone from 4,100 points up 300 points to just above 4,400. That's a roughly 8% move in the space of 2 weeks. For an index itself, it's a very, very large move. They did bounce off their sort of medium to longer term uptrend line, and they have broken through the sort of medium to short term downtrend line. A little hard to say where they'll stall. I'd be looking at about 44.40, 44.50, and like I said, even though they do have this strong upwards momentum, they are looking quite a bit overbought in the short term, and I wouldn't be committing to any significantly bullish trades, at least until we see a pullback and at least until we see potentially a higher trough. Again, you'd be a bit bold or a bit brave to do anything ahead of tonight's CPI reading in the US as well. You want to see that CPI come down, and you want to basically see the market confirm with itself that interest rates are probably at their peak. Alright guys, I will wrap it up there for this week. Hopefully you enjoyed. If you did, give us some love in the comments, click like, and we'll see you guys in the next one.